There are two energy crises happening at the same time right now. One is in the news, the other one is not. Both of them are quietly transferring hundreds of billions of dollars from regular consumers to the same group of asset owners on Wall Street. The first crisis is the one you have probably noticed. Gas prices are up. The Strait of Hormuz, the narrow waterway that carries about a third of the world's seaborne oil, has been effectively closed since February 28th. The Iran conflict that caused the closure is now in its fourth month. Brent crude oil hit $107 per barrel in May. Wholesale gasoline prices are up roughly 50% compared to where forecasters thought they would be 6 months ago. Jet fuel nearly tripled after Middle Eastern exports were cut off. The International Energy Agency calls this the largest oil supply disruption in modern history. About 11.3 million barrels per day of production have been shut down. Some of that oil is sitting in storage tanks that are now completely full. Iran has been forced to shut down additional production because they literally cannot store anymore. That is the crisis you can see. By the end of this video, you will understand the second one that nobody is talking about, why both crises are making the same group of investors fabulously rich, what to actually do with your money in this environment, and the one investment most people are missing that lets you profit from this pattern instead of paying for it. Let me start with who is winning from the Hormuz crisis. American oil and gas exports just hit a record. In April, US net exports of crude oil and refined products climbed to 5.8 million barrels per day. The May number is close to that. When Middle Eastern oil cannot reach Asian and European markets, those buyers turn to the United States. American oil majors like ExxonMobil and Chevron are seeing record export volumes at record prices. US shale producers in Texas and North Dakota are pumping at maximum capacity. Pipeline companies like Energy Transfer and Enterprise Products Partners are collecting transit fees on every barrel that flows through their infrastructure. This is the pattern in every energy crisis. The people who own the infrastructure win, the people who buy the output pay. The wider the price spread between crisis levels and normal levels, the more profit the asset owners capture. Now let me show you the second crisis. For most of the last 20 years, electricity demand in the United States barely grew. The economy expanded, but power consumption stayed roughly flat because of efficiency gains. New refrigerators used less electricity than old ones. LED bulbs replaced incandescent. Modern factories ran tighter than legacy ones. That stopped in 2024. Global data center electricity consumption was growing about 3% per year through 2015. By the mid-2020s, that growth rate had jumped to 10% per year. In 2024, data centers consumed roughly 415 terawatt-hours of electricity worldwide, about 1.5% of global electricity demand. The United States alone accounted for 180 terawatt-hours, about 45% of the global total. By 2030, multiple credible projections show data center electricity demand could triple. Some forecasts go even higher. Artificial intelligence is the single biggest driver. Training one large AI model can use as much electricity as a small city consumes in a month. Running inference for billions of daily queries adds permanent baseline demand that does not go away. This is creating a different kind of energy crisis, not a supply shortage, but a demand explosion that the existing power grid was never designed to handle. Utilities are scrambling to add capacity. Nuclear plants that were scheduled to be decommissioned are getting restarted. Constellation Energy signed a deal in 2024 to restart the 3 Mile Island nuclear reactor specifically to power Microsoft data centers. Constellation stock is up roughly 400% since that announcement. Vistra Corp, another nuclear operator, is up similar amounts. Natural gas pipeline companies are signing 20-year contracts to deliver fuel to new gas-fired power plants, being built specifically for AI workloads. Now here is where both crises converge. The Hormuz crisis is making oil majors and pipeline operators rich. The AI demand crisis is making power generation owners and natural gas pipeline operators rich. The investors who own both categories of assets are getting hit from two directions at once. Their oil and gas pipelines are generating record fees from international export demand. Their power plants are signing premium contracts with hyperscalers like Microsoft, Google, Amazon, and Meta. The same handful of energy infrastructure investors are profiting from both stories simultaneously. You pay for both. Higher gas prices at the pump, higher electricity bills at home, higher prices on everything that uses energy to produce or transport, which is everything in the modern economy. For 2026 alone, energy infrastructure as a category is on track to deliver one of the strongest returns of any sector in the market. Pipeline master limited partnerships are paying dividend yields of 7 to 9% while the underlying companies grow revenue. Oil major free cash flow is at multi-year highs. Nuclear operators are getting valued like growth stocks instead of utilities. Here is what to actually do. If you want exposure to oil and gas without picking individual stocks, the standard approach is the Energy Select Sector SPDR Fund, ticker XLE, which holds Exxon, Chevron, and the major US producers. For pipeline exposure with high dividend yields, the Illyrian MLPETF, ticker AMLP, holds the major pipeline operators. For the AI power story, individual nuclear operator stocks like Constellation Energy and Vistra are the cleanest plays, but they have already run a lot. The Utilities Select Sector SPDR Fund, ticker XLU, gives you broad utility exposure if you want the demand story without picking winners. Do not trade oil futures directly. Retail accounts get destroyed in commodity futures because of contract roll costs and margin requirements. The energy story is real. The way to access it as a regular investor is through stock and ETF exposure to companies that own the actual infrastructure. Here is the broader takeaway. Every energy crisis in modern history has transferred wealth from consumers to infrastructure owners. The 1973 oil embargo made the Saudi royal family one of the wealthiest dynasties on earth. The 1979 Iranian Revolution did the same. The 2008 oil spike made hedge fund managers and shale producers fabulously rich. The 2022 Russia invasion did the same again. Every single crisis follows the same pattern. Prices go up, consumers pay, asset owners capture the difference. The 2026 dual energy crisis is the latest version of this pattern, except this time it is hitting from two directions. The Hormuz situation is short-term and probably resolves over the next 12 to 18 months. The AI electricity demand story is structural and lasts for decades. You can argue with the political causes of either one, but you cannot argue with the math. The infrastructure owners win, the consumers pay. Your choice is whether you want to be on the infrastructure side or the consumer side of this transaction. That is the actual decision. But there is one piece of the story I have not told you yet, because while everyone is focused on oil and natural gas, the next 20 years of energy infrastructure investment is going to be dominated by something most people do not understand and almost nobody has positioned for. In the next video, I'm going to show you exactly how nuclear power is about to become the largest investment opportunity of the decade. Why the same hyperscaler money that drove Nvidia from a chip company to a $4 trillion valuation is now flowing into nuclear, and the one specific company that is positioned to become the Nvidia of energy.